Welcome to Within the Frame, where we bring the most pressing issues across the globe into focus. I'm Kim Mok-yeon. South Korea's economic policy is standing at a crossroads. The Bank of Korea's latest decision to hold its base rate at 2.5% despite slowing domestic demand reflects a growing tug-of-war between financial stability and the need to jumpstart growth. Household debt continues to climb, and real estate markets are showing signs of overheating, and uncertainty from abroad is also only adding fuel to the fire. Now, at the center of those external risks is Washington's renewed tariff push. With an August 1st deadline looming, Korea now faces the prospect of sector-specific U.S. tariffs before a broader agreement is in place, a scenario that worries export-dependent industries. To explore these challenges further today, we are joined by experts here in the studio with us. To my left is Kwak Jun-hee, Assistant Professor of Economics at Seogang University. Welcome, Professor Kwak.
Thank you.
And also to my right is Hong-Soo Eric Kim, CEO at DataCrunch Global and adjunct professor at Yonsei Graduate School of Business. Good to see you, Professor.
Thank you for having me today.
So let's start a discussion with Professor Kwak. With the BOK's latest policy move, of course. So I would want to ask, what's your assessment of the latest decision to, freeze the rates at 2.5% in July, despite previous easing moves?
Yes, right. I believe the central bank decision to freeze the base rate at 2.5% was the right way to go. A primary consideration was the rising housing price and associated household debt accumulation, because they want to mitigate the potential risk and they want to calm market participants, so they needed to calm down the market by maintaining the policy rate. So I acknowledge that the current economic downturn, because the Bank of Korea now they forecast that the economic growth this year will be only about 0.8%. So we definitely need some stimulus in the economy. However, they gauge the pros and cons of expansionary monetary policy, and I think they believe that financial stability is key now. So, and there are other factors like the interest rate gap between Korea and US is highest these days, and moreover, recently the government started expansionary fiscal policy, so it reduced the need for expansionary monetary policy. So I believe this was a right decision.
Mm-hmm. So, Professor, then given this latest pause by the central bank, what do you think this signals about their policy priorities? Do you think it's leaning towards financial stability rather than, growth at this stage?
Yes, it's evident that I think the Bank of Korea is prioritizing financial stability over a business cycle stabilization. And the governor's explicit concerns was about also rising housing price. So I believe short-term focus on financial stability is right way. And it's a crucial step also toward achieving long-term stabilization in economic outcomes. And this is because history shows that the rising housing price and associated debt accumulation often ends up with recessions and even financial crisis. So to maximize long-term welfare, I think also it's very important to keep in mind that financial stability should be the first concern. And in the short run, I advocate for maintaining the focus on calming the housing market. The reason is that it seems that the housing market is so booming, and people, they receive news from, a rising housing price in Gangnam area, for example, and it seems they're overreacting to news. So it's very important to provide signal that the central bank is not willing to allow those booms in housing market. So of course, the government is now implementing very strong mortgage loan regulations, and it seems very effective now. However, as we know, the long-term effect of such regulation is not clear, and we learned that under the previous administrations. So in the long run, I argue that the central bank should be equipped with a comprehensive macroprudential policy tools such as loan regulations And that's exactly what the governor of the Bank of Korea recently mentioned. And in theory, we economists know that an independent policy institution like the central bank, they are able to achieve both price stability and financial stability when they're equipped with both monetary policy and macroprudential policy tools. So I argue that in the long run, we should go that way.
Right. Maintaining stability would be very important at this point. But as our Professor Kwok has mentioned about loan regulatories, with interest rates very high and debt levels also rising, Professor Kim, what do you think? What kind of risks do you see for South Korea's financial system and also for companies trying to borrow some money?
Okay. First of all, our economic outlook has decreased from a 1.5% forecast to 0.8% forecast by the Bank of Korea. That's only, in a 5-month period, we are almost, predicting that our economy will grow by half of what we have forecasted. So the domestic economic situation is not really good at the moment. But we also have to understand how companies work. If there's something that we can predict, then companies can make predictions and strategies. So I think the BOK gave a strong message that they will hold on to 2.5% interest rates for some time period. I think that's a positive side. However, as you mentioned, we have a significant debt both in the household sector and also in the corporate sector as well. So the cost of capital procurement will rise because of the competition for companies to procure capital, especially when the interest rate is high. Certain industries such as petrochemical or construction, which require intensive capital backing and the harvesting period is long, become very much hit. So we would probably expect a lower credit rating in the coming quarters in those sectors, in the petrochemical and the construction sector.
Mm-hmm. So, Professor Kim, in light of this very cautious macro environment, how are Korean firms actually coping with the BOK's latest stance and also their regulatory signals?
Mm-hmm. So, as I mentioned, in a company's standpoint, if there's something predictable and stable, then companies can plan out. So the BOK is giving a strong message from the current recent, household debt regulation and real estate debt regulation, that they will hold on a tightened, financing to the public market. So companies will get onto an emergency plan. They already on an emergency plan, but they will continue their plan to reduce investment and to operate in very, very tightly expected cash flow. So that's the company's standpoint. But also at the same time, we have a lot to deal with the U.S. situation and the global economy. So always a risk is an opportunity and a risk. So companies should wisely utilize this period to grow amidst the very difficult time of the global economic situation.
Mm-hmm. It's a very crucial period for
Yes.
local firms as well. Now, let's zoom out a little bit to, global dynamics, Professor Kwok. Given the historic 2% interest rate gap between Seoul and Washington, as you've been touched upon a while ago, how much room do you think does South Korea have for further independent rate cuts without risking capital outflow?
So my feeling is that we don't have much room. So as you mentioned, the interest rate gap between Korea and US is a record high, 2 percentage point. And historically, we know that there is a clear correlation between interest rate gap and capital outflows. And I believe the Bank of Korea understand that dynamics. So they are now willing to accept a further interest gap, I think. However, I think it's essential to recognize that the capital flow dynamics is complicated. What I mean here is that the interest rate gap is not the only factor that determines capital flows. To understand flow dynamics, we need to think from the perspective of a global investor. So Korea is just one set of their diversified portfolio. And what they consider is not only the interest rate gap, but they also think about returns, and that should be adjusted by risk. And the example is recently we observed the rise in KOSPI index, that's the Korean benchmark stock index. And the main reason was, of course, there was a US tariff policy, but as well as we had changes as fundamental in Korea. So it seems global investors evaluate fundamentals of Korea, and that's independent of interest rate gap between Korea and the US. So maybe there's a little bit more room because investors are quite seems positive on Korean market. One another point is that due to recent US tariffs, it seems that there's a growing sentiment that maybe this US tariff policy might hit US more severely than other countries. Maybe that includes Korea. Mm-hmm. So we observed that there was US dollar depreciation actually, and people are rethinking about the dollar dominance or status of dollar in the global financial market, and that's what global investors are talking about. So considering that maybe Korean asset becomes more attractive relative to US asset, then maybe we don't need to worry so much about that.
Right. So we cannot really not talk about American tariffs when we talk about South Korea's economy lately, especially as the August 1st deadline is starting to get near. So, Professor, then what kind of risks, economic risks, does South Korea actually face if the U.S. imposes sector-specific tariffs before we come up with a full agreement between the two sides?
Right. Actually, the imposition of sector-specific tariffs on key industries in Korea, like automobile or steel, that would inflict significant harm on our nation's exports. Then the problem is the export revenue of targeted firms decline, and those firms are not able to maybe pay wages to their workers, or they are not able to pay bonuses to workers, and they can hire more workers, and then they are not willing to make more investment or do R&D, and that will hamper long-term growth as well. And then problem is, if workers are not paid their wages, or if they cannot get jobs, consumption goes down. And it means overall demand in Korea can go down, and then we can have recessions. So that's the problem. And moreover, because there is an uncertain path of tariff policy, so there are a lot of uncertainty, then what we economists know is that firms will be likely to adopt wait-and-see approach. Mm-hmm. So due to uncertainty, maybe they postpone their investment or R&D expenditure, and that will drag our economy further.
Right. So it's definitely a time for many of us to be cautious, especially your companies as well. Now, speaking of which, so we have to talk about how we're trying to resolve this issue. Professor Kim, Seoul is now pushing for the so-called phased landing zone approach to, negotiate security and economic issues as a package with the U.S. How effective do you think is this approach in mitigating business uncertainty in the nation?
So the White House representative, announced a couple of days ago that they're giving a beautiful letter to Korea and Japan, imposing a 25% tariff effective August 1st. So we only have 2 weeks. So the government is working really, really hard to pull together different ministries in Korea to come up with a comprehensive deal. I think we have to first understand why Trump is imposing tariffs around the world. Basically, U.S. economy works on U.S. Treasury bonds because U.S. consumers like to buy a lot of things from overseas. So we would generally expect a trade deficit. Recently, also, they have a government deficit, so fiscal deficit and a trade deficit is causing a severe problem in the U.S. economy. However, if U.S. is able to sell U.S. bonds to other countries, then the problem is resolved. But China, if you look at the U.S. bond holdings starting compared to 2013 and recently, China was holding about 1,300 billion U.S. Treasury bonds, but now they only have about 750 U.S. bonds. So that's almost a 45% decrease. So the nutshell of this tariff war is a chip war, semiconductor war, and a currency war. So what U.S. really wants is adjusting prices for their imports and exports. In that discussion, there's a lot of things that we cannot agree on between United States and Korea. For example, U.S. will demand opening our agricultural market and even lifting sanctions on their U.S. beef, but which is very, very hard for Korea to accept for domestic reasons. It's going to be an dynamite if we accept that position. But one thing that aligns is probably interest rates. Korea cannot lower interest rate at this moment because of the government policy. We're very, very concerned about the household debt and also the public debt. And although it will be great if we can lower the interest rate, it's just our debt situation that makes it really hard for us to lower the debt. The U.S. does not want Korea to have a greater spread between interest rates because that will lower the value of U.S. dollars, which makes the trade discussion more difficult. So probably we can give U.S. a strong message that we will hold the current interest rate at this level for a certain amount of time so that we can manage the currency situation so that U.S. will have a more favorable term when trading with Korea. So I think that's the best negotiation strategy that we can pursue by protecting our agricultural sector and also protecting our manufacturing sector. We also should give a big commitment on investing in U.S. In the package deal, I think. Yeah.
But what about for Korean companies, Professor? Then what strategies could be used to minimize the tariff exposure for South Korean companies?
Okay, so I think what's interesting is what's happening in Japan. So Ishiba met Trump, at the beginning of this year when he was inaugurated, and promised a $1 billion investment to Trump. And Trump is now imposing a 25% tariff to Ishiba. And Ishiba, because he's facing elections soon, he's saying that first he's pursuing a Japan first policy in terms of that. But the reason why Trump is imposing 25% tariff to Japan is because the speed of investment execution is not fast enough. U.S. needs investment right now. So as a company standpoint, we can probably wisely use this situation. Whenever there's a risk, there's also opportunity. Probably current companies can commit a bigger investment in the U.S. and expand to the U.S. market. But however, we can also negotiate to finance that with the U.S. government-backed funding so that we can find this funding sources while also meeting the U.S. requirements for investment. So I think that would be the best strategy that we can think about amid this trade war.
Right, so making use of some possible opportunities in the U.S.
Yes, but asking U.S. for funding.
Right.
Yes.
Now, so given the situation, there's a lot of uncertainty in the Korean nation. Professor Kwok, the government seems to have a lot of policies like providing supplementary budgets and laying out consumer coupons. Do you think they could genuinely help cushion Korea from this looming external economic shocks?
Right. So of course, so those are called expansionary fiscal policy. So in the short run, those types of expansionary fiscal policies are an effective tool to counteract reduction in overall demand. So because tariffs, the rise in U.S. tariff against Korea will, for example, first of all, reduce export, of course. Then what happens is, as I mentioned before, overall demand in Korea will go down. because farm revenues go down and workers cannot be paid and consumption goes down. And then what happens is, because consumption goes down, now farms are not able to produce more because they expect that they cannot sell more products in the future, and so on. So it's like vicious cycle. So there will be very large reduction in aggregate demand. Then if we provide transfers to people, then it helps boost demand again. So we can stabilize our economy using supplementary budgets and targeted consumer coupons. Specifically, it will be very effective for households with low income or those who are credit constrained, because we say the marginal propensity to consume, that's called insured MPC, of those low income households and credit constrained people are very high. What it means is that in response to $1 transfer, they are likely to increase consumption more than other people. So I think their transfer policy now will be effective. So that's what I like. However, there is a caveat because it has limits. Because the public debt is also rising recently, together with household debt and corporate debt. And the problem is this type of expansionary fiscal policy cannot be sustained for an extended period. So we should stop at some point, because if we think about, again, global investors, if we accumulate a lot of public debt and our government expenditures are financed by more government debt again and again, then it means the default risk of Korea might increase. Of course, this is now stable, but we don't know the future. Then maybe we have some unintended consequences like a fiscal crisis in the future. So we should be very careful about that.
Right. So as for the short run, it would be definitely helpful in boosting, maintaining domestic confidence. But we'll have to see how trade issues move on in the next 2 weeks. So yeah, I'm afraid we'll have to conclude our discussion at this point. But thank you so much for your time, Professor Kim.
Thank you very much.
And Professor Kwok.
Thank you for having me.
We appreciate it so much. And that'll be all from us on Within the Frame tonight. Be sure to tune in again next time as we continue to explore the stories that matter. Until then, stay informed and engaged.